Hi friends, so today I'm going to start with the RTP discussion. ICI has released the RTP for your September exams and I thought this is a good time to discuss the RTP. Today first I'm starting with FM RTP. I'll discuss costing RTP in few days. As far as FM RTP is concerned, ICI has given 12 questions. Most of the questions are repeat of what we have seen in our material except for question number 1, extremely lengthy and extremely tricky question. I think it has become a habit of ICI, or this is how RTPs have been. Your question 1, which is your case scenario based question, which is MCQ based, it has been coming very tricky in exams, so very tricky in your mock test as well as RTP. Final exams, because we cannot see the paper, I cannot comment that how tough it was in the May exams, but here people who have written May exams, maybe you can comment in our channel that whether it was an extremely tough one or was it a relatively easier MCQ based case scenario. But MCQ based, so in short, securing full marks in MCQ can be very difficult because the questions are on the tougher side. I'll discuss question 1. I'll first read out the question. Mr. Ronak, a doctor by profession, has his own private hospital at Goa, having specialization in cardiac treatment. Nowadays, Goa, not only being a place for the tourist, is also a place for business delegate, cultural people, politicians, students, and other classes of people. Goa is opening new windows for businesses and getting recognition as an important tourist and leisure hub in southwest India. Just give me a minute. Okay, sorry. Then there are a number of hotels and resorts at Goa. However, the need still exists for more hotel services, in particular with the excellent service, because of the large number of visitors from all over the country and all walks of life always favor Goa state for the recreation. Now, I'll keep reading it, but I'll tell you one thing. Whenever it's an MCQ based question, first thing you do is please read out what are the requirements, because your mind will be tuned to that. So let us look at the requirement. Amount of net initial investment required, which is technically called net outflow. NPV of the project is asked. Payback of the project is asked. Accounting profit or loss. So PAT needs to be calculated, which will come from cash flow. And IRR of the project is asked. So multiple requirements are there. Net initial investment, NPV, payback period, recurring accounting profit, and IRR of the project. So these requirements are there. I'll read it with that mindset. Para 1, 2, 3, not of much use. I do not have anything which will impact my cash flow. Para 2, I have read. Mr. Ronak, although being a doctor by profession, is contemplating to establish a 5-star hotel at Goa. So he is going to set up a 5-star hotel in Goa. The hotel will consist of 5 floors. Hotel will also include 40 normal rooms, 8 deluxe suites, as well as a restaurant, couple of conference rooms. Following are the estimated occupancy rate. This will give me my revenue potential. Let me calculate the revenue potential now itself. 8,000 into 40 and 120 days. The occupancy is 120 days, and as it's going to be a growth of 12% in rent. This is the revenue potential. Then 25,000 into 8, occupancy is 120 days, growth of 9%. Conference hall 3 lakh rupees, 2 conference room into 2 into 40 days, and restaurant is 27,000. It will be 360 days. Last line of the question will say it's 360 days in a year, and there is an increase of 12, 9, 9 and 8. For the sake of simplicity in calculation, growth rate to be applied once after completion of 10 years. This makes it little easier for us to solve the question. After 10 years are completed, I'll apply the growth rate. Land will cost 250 million. The question had somewhere asked, what is my initial outflow? So my initial outflow is 250 or 2,500 lakhs of land. Construction cost is 1,000 lakhs. As I'm reading, I'm writing the numbers because my mind is now tuned to understand what is the requirement. The requirement was net initial outflow. So 2,500, 1,000 for construction cost, Furniture is 1,50,000 into 40, 1.5 into 40, we are doing it in lakhs. And then deluxe room is 3.8 into 8. Then conference room with wedding hall, 2 conference rooms are there. Cost is 7 lakh each. Cost is 7 lakh each. What I'll suggest is you please pause the video, read the entire question once at your end, because I've been explaining this. But you read the entire question once fully. You take around 7-8 minutes to read the full question and then start viewing my explanation. 7 into 2. And this is, then for restaurant it is 10 lakh. I'm not putting a total, I'll put a total in the end. Then in addition, I'll need 4 elevators. I need 4 elevators. 4 elevators is 4 lift at a cost of 35 lakh each. At a cost of 35 lakh each. So 4 into 35. And then I'll need an electronic appliances which will cost me 35 million. 350 lakhs. Elevator will be depreciated at the rate of 5%. So whatever is the cost of elevator into 5% per annum is the elevator depreciation. Electronic appliances will have a salvage value of 15%. Cost minus salvage value divided by 15 years. Hotel will be built by a renowned builder called Harrier Infrastructure. Building will survive for 15 years. So depreciation of building is cost of the building minus salvage value divided by 15 years. Cost of the building minus salvage value divided by 15 years. Furniture, local reputed furniture. Furniture will go on for 10 years very smoothly. So whatever furniture cost you did, subtract the salvage value and divide by 10 years. Subtract the salvage value and divide by 10 years. At the end of 10th year, new furniture for normal room and deluxe room will be bought, and old furniture for the same will be sold by the hotel owner. The owner of the hotel estimate that for the newer furniture which you have to buy, 15% higher. This is talking about normal room and deluxe suite. We are just talking about there are 4 types of furniture. One is for normal room, one is for deluxe suite, one is for conference, and I think the last one was for your restaurant. In that normal room and deluxe room will have a life of 10 years, and replacement at the end of 10 years will cost us 15% extra. The salvage value at the end of 10th year will be 5% of the purchase price with no book value remaining. Furniture at restaurant, conference, wedding hall will not require any major changes. Minor renovation at the end of 12th year, which is 20 lakh rupee, and scrap generation is 175. 20 lakh rupees is the expenditure. Scrap generation is 175. Net 1825. Net it is 1825 at the end of 12th year. So there is one capex at the end of 10th year, one capex at the end of 12th year. At the end of 12th year, in order to boost tourism industry, the state government will be granting subsidy of 15% of the initial capex incurred at the time of cost incurred. Whatever amount you have incurred here, subtract 15% because you will get a subsidy. You will get a subsidy at the time of the capex. Subsidy at the time of the capex. That is why the questioner used the word net initial investment. If you see the wording in the question, it says net initial investment. So 15% we can subtract. We can end up subtracting 15% from this number. I'll show the calculations and all in some time. Then additional subsidy of 10% of revenue expense. So whatever revenue expenses we are incurring, government is saying I'll give you 10% of that for the first 3 years, year 1, year 2, year 3. But this will come to us at the end of 5th year, and the same shall be non-taxable. Subsidy, they have said it is non-taxable subsidy. We will receive at the end of 5th year. We will receive this at the end of 5th year in our bank account. Then annual recurring expense will be 180. It includes all those expenses related to manager, staff, employee, utility, housekeeping, security services. On this, I'll get that subsidy also. At the end of 10 years, recurring expense will increase at the rate of 10%, which is to be applied once. Good part, only once application. Only once application. Hotel authority is determined to provide the best and professional hotel services. They decided to spend 5 lakh per year for the purpose of training. So training is 5 lakh. Totally 15 years is the calculation. Hotel project will be entitled to tax holiday for the first 5 years. So first 5 years no tax. Year 6 to 10 tax is there. 11 to 15 all those changes will happen. There is an increase in prices for your normal room, deluxe room, expenses, everything. Depreciation is on SLM basis. SLM makes it easier. First is net initial investment required. Net initial investment required, as I had explained, it's total of all of this. First is land, second building, furniture of a normal room, furniture of a deluxe room, then furniture of a conference facility, furniture of a restaurant, elevator facility, electronic appliances, and deduct 15% as a subsidy. So what is the calculation? Now, when you see an exam question, this is easy to get. At least secure 2 marks. It is easy to score marks on this. It is very difficult for the other questions, but at least let's secure the marks which are easier for us to get. So this is easy to secure. I'll get my 2 marks. It is 34.887 is the answer, but this is the calculation. Land, construction cost, furniture cost, 4 items, elevator cost, electronic appliances, initial outflow, 15% subsidy, and net outflows 3488.74 lakhs or 34.887 crores. 34.887 crores is my initial outflow. Initial outflow is 34.887 CR. So this is my answer. This is fairly simple for me to get. Then comes my in-between flow, NPV of the project. I'll split the in-between flow into 2 separate items. One is called recurring item. Second is called non-recurring item. Non-recurring I'll do separately. Recurring I'll do separately. Then club the cash flows in the end. Because otherwise I have to write year 1 separately, year 2 separately. 15 years separate calculation is very difficult for you to do. For me in Excel, everything is easy. But for you, it can become extremely tougher to do. So we are going to do year 1 to 5 separately because no income tax in this. 6 to 10 separately, income tax there. 11 to 15 separately. In this calculation, there is some price rise and all. Once this is done, I'll be able to get this also. Accounting profit or loss. For the first 3 years means whatever number you get, add that subsidy component. Why I'm saying adding the subsidy component? Because in cash flow, it can't come. In the cash flow, it can't come because in cash flow, it is received at the end of 5th year. So I'll be able to get this part of the answer also, which makes it little bit easier for me to go to my final answer. Makes it easier for me to go to my final answer because I have 5 requirements in the question. Now, coming to my revenue item, I'll quickly discuss the revenue item. I've already discussed it. Revenue is 40 into 8,000 into 120 days, 25,000 into 8 into 120 days, 3 lakh into 2 into 40 days, 27,000 into 360 days. This is for year 1 to 5, 6 to 10. 11 to 15, whatever revenues you are making earlier at 12, 9, 9 and 8%. 12, 9, 9 and 8%. I'm not doing the calculations because printed solutions are given. Because if I do calculation, focus shifts on doing calculation at your end rather than understanding things. At your end, I obviously suggest you to solve this question once I am done, because once I am done, when you solve it at your end, your revision is over. That's how I will be discussing this RTP. So, as I said, 8,000 into 40 into 120, 25,000 into 8 into 120, 2 into 3 lakh into 40, 27,000 into 360. This is my revenue. This is my revenue with a 12% increase, 9% increase, 9% increase, and 8% increase. It is a fairly simple approach, simple increase you need to adapt on. 12, 9, 9 and 8% increase you need to give for the 4 periods, for the 4 items which are there. Now coming to the expenses, first expense was 180 lakh, which is what that recurring expense, that will increase by 10%, 180 lakh and increase by 10%. I've done the calculation in lakhs. So 180 for year 1 to 5, 6 to 10 and 11 to 15 at 10%. Training expense, no increase is given. Ideally increase can happen here also. 5 for 1 to 5, 6 to 10 also 5 and 11 to 15 also 5. Then comes depreciation. Depreciation ideally is not needed for 1 to 5 because tax is not there. But still I'll have to calculate depreciation because 1 to 5 they've asked what is the profit you're going to make. What is the profit you're going to make? So it's better to do the calculation of depreciation for 1 to 5. Now depreciation, we have multiple items. Let's discuss item by item because that makes it easier for me to do. Zero depreciation on land. Zero depreciation on land. There's no amount of depreciation to be provided. Land is not depreciable. Construction cost 1,000. Salvage value is 250, 25%. 15 years. I'm discussing each of the item. Anywhere there is a confusion, you see the detailed calculation. 1000 minus 250. I say in the RTP I have not shown any calculation. So this is the easier way. 1000 minus 250 divided by 15 years. Furniture, question has said no depreciation on restaurant furniture, conference, wedding hall. No furniture on, no depreciation on your restaurant, conference and wedding hall. So only two types of depreciation. One is here. There is one error in question according to me. Please, you can change the question itself. That's how ICAI has solved it. They should not mention with no book value remaining. This is wrong. The word no book value remaining should not be there in the question. That's how they've solved the question. I'll solve whatever they have done. Salvage value is 5% and my depreciation is going to be cost minus salvage value divided by 10 years. And thereafter my cost will increase by 15%. Salvage value discussion is not there for the rework, that is the revised furniture. And I'll divide that by 15. I'll divide by another 10 years. The furniture has a life of 10 years. They ensure that the furniture will go for 10 years very smoothly. At the end of 10th year, new furniture for normal room, deluxe suite. So normal room and deluxe suite put together is 60 plus this 60 plus 3.8 into 8. Let me check the calculation. Just give me a minute. So 60 and 3.8 into 8 put together is 90.4, 5% salvage value. This is my depreciable base and I divide this by 10 years. This is my depreciable base and I divide this by 10 years. This is for furniture for the first 10 years, 1 to 5, 6 to 10. Thereafter, this will go up by 15%. This will also go up by 15%. Salvage value information is not there, so I'm not taking it. Divide by 10. I can assume that salvage value can be 5% also. Why we are dividing by 10 years? Because the life of the furniture is 10 years. The hotel is there only for 15 years. What is happening beyond 15? ICAI has not given. And they have just done calculation for 15 years. But depreciation, they charged it for a period of 10 years because the life of the asset is 10 years. The life of the asset is 10 years. Maybe again the building is constructed. All that can happen. We are not getting into that discussion because that data is not there, and if that was given it will become more and more complex kind of a question. So elevator at the rate of 5%, whatever is the cost at the rate of 5% is the elevator depreciation. Into 5%, 140 into 5%, and then we had electronic appliances 350. 15% is 52.5 divided by 15 years. This will give me PBT, deduct PBT, after depreciation, deduct tax 0 for 1 to 5, 6 to 10 taxes there, 11 to 15 taxes there. So you see the calculation 180, 198, 555, 50, 50, 50, 8.588, 8.58, 10.396 as I did the calculation. 8.58, 10.396, 5%. Electronic appliances we have taken, so you'll have to take this and you get profit before tax, which is 690.7787, 690.7787, 768.0267. Tax at the rate of 25% is to be deducted. Add back depreciation CFAT. This, if you see the heading, I've used the heading recurring flows. Then there are certain non-recurring flows which are coming in only few years. What are the non-recurring flows? One is there is a subsidy which we are going to receive. What is subsidy? 185 into 10% into 3 years. This will come in 5th year inflow. I don't want to write it here separately, then 1 to 4 separately, year 5 separately. I'll club this calculation later. So one is a subsidy which is going to come. At the end of 10th year, you will sell your old furniture and buy new furniture. You will sell your old furniture and buy new furniture. Sale value of old furniture is 4.52. New furniture is 103.96. 103.96. This will happen in 10th year. This will happen in 10th year. So certain items which is there. One is your furniture which will happen in 10th year. And there's another furniture. 20 lakh adjusted for 1.75. 20 lakh adjusted for 1.20 lakh is outflow. salvage value is 1.75, 18.25 is the outflow in the 12th year, outflow in the 12th year. And once the project is over at the end of 15th year, I will get back entire 250 from land. Construction cost, we are going to get back 1000 into 25%, 1000 into 25%. Estimated salvage value at the cost of the construction is, this is 2500 lakhs. This is 1000 into 25%, 250. Nothing on furniture, I know. Elevator, they have not mentioned anything. And your electronic appliances, you will get 15%. That is 3500 into 15%. So this is called non-recurring. And we'll club them together. In between, one-time cash flow, furniture purchase in year 10, old furniture salvage value, subsidy, renovation expenses, salvage value of building, salvage value of electronic appliances, and salvage value of land is given, which is 250. Just give me a minute. Just 1 minute. Sorry, there is an error. Okay, let us take this as 250. 1000 into 25%. 1000 into 25%, 250. Salvage value of electronic appliances is 52.5. Land, I think ICA has not taken. Land has not been taken, and the total is 302.5. Salvage value as per ICA solution is 302.5. They have not taken the land value. They have not taken the land value. Let me follow whatever ICA has done. 302.5. 302.5 is the total cash flow. Total cash flow at the end of 15th year. And I'll club this and calculate NPV and IRR. Because I made this correction in the file which I upload, I will rectify this. Well, it's not an error technically. There is one zero which got missed out, and ICA has not considered salvage value of land. So I'll write a note on that in the printed solution. And I'll now do the NPV and IRR calculation, because answers are going to change year 0 to 15. It's a very lengthy calculation. Can't help it. I have been telling students that such difficult questions may not come, but looking at the frequency, ICA may end up even asking such a tough question also. Initial outflow 3488.74. I'll go to the respective working note. First working note, I pick up 3488.74. Then I pick up from here 776.20 for 5 years. I'll make changes on this in a minute. Then 603.5053 for 10 years. Then 663.2493 for 5 years. In that, year 5, add another 55.5. Add another 55.50. Year 10, subtract 99.44. Year 12, subtract 18.25. Then year 15, add back some error in the I'll correct it. Whatever PDF you're going to see may not see this error. 302.5 PVF at the discount rate is, this is also a very good adjustment. They have set cost of equity is 12%. Hurdle rate is the discount rate. Hurdle rate is 15%. Hurdle rate is 15%. So hurdle rate is called as the discounting rate at 15%. 1 divided by 1.15. You need not worry about these computation. DCF. I get NPV of 705.95. 705.95, that is 705.95 lakhs, 7.0532 crores. 7.0532 0532 crores. The closest one is this. The balance is rounding off gap. The balance is rounding off gap. 705.95. 705.95. Payback period is year. Cash flow, I'll have to add something called as cumulative cash flow. I'll have to add something called as cumulative cash flow. So year 0, moment it becomes positive. It has become positive in the 5th year. So payback is 4 plus 383.94 divided by 831.70. Unrecovered cash flow of the base year. Unrecovered cash flow of the base year. How much is unrecovered in the 4th year? Divide by the cash flow of the next year. Divide by the cash flow of the next year. See this videos, I'm assuming you have an understanding of payback and all. This can't be for first time learning. This can't be for your first time learning. 4.46. That's my payback. And then accounting profit for the first 3 years is whatever profit I got earlier from here. 690. Add subsidy component. What is subsidy component? 10% of 185. 18.5. Add the subsidy component. 10% of 185. 690.7787 plus 18.5. 709. 709.2787. 7.0928 crores. And IRR has been asked in the question. 15 we have already done. I'll be doing a 20%. In the end, I'll get an IRR of 19.39. At 20% if you do, you'll get a negative NPV. Why 20? Because these are the options. In fact, the question gave positive NPV in all the 4, which means the project is going to have positive. In case in an exam, you're not able to solve the question 2, you take a guess estimate. IRR, what you can do, it can't be 15, it can't be 12. Why? Because my cost of capital is 15%. If positive means IRR is more than 15. So either 16.25 or 19.39. Somewhere you will have to do some guess estimate and write the answer in case it becomes very lengthy. And if such a question comes in exam, please answer this in the end. Answer this type of a question in the end. In this video, I have not even solved the question fully, but it has taken me 27 minutes to discuss this. I have not solved the full question. If I had solved the full question, it would have taken me around 1 hour to solve it. And at your end also in exam, it can take around 40 minutes, which can take away a lot of your time. So you'll have to be a little smart in answering this. I have to make one correction. That is, I'll follow whatever ICI has done. ICI has taken this to be 302.5. So if I do that, the small changes will happen, and 19.4 you will get, a 19.3, no, whatever answer you get. That doesn't really matter. With this, my first question gets over. As I said, you guys can comment in the video if you have written your May exams and let me know whether in exam also they asked a very tough MCQ or not. Because I've been seeing mock test question, I've been seeing RTP, that is extremely tough. The first case scenario has been extremely tough. I would suggest you to take a pause, that is pause the video for 2 minutes and go through the entire solution. In my printed material, that is the uploaded one, you will see only 302.5. So you take a break, that is you pause for 2 minutes and then start viewing the next items. Okay, I'll now move to the next question. Before that, as I said, I've rectified this. When I pause the video, I've rectified it, and this will be the answers. But this will match ICI solution, and we are not considering salvage value of land. Now onwards, the questions may not take that much time. K Limited's opening stock is 250, closing stock is 375, sales is 13 lakh. GP ratio is 25% on sales. Accounts payable 80,000. Creditors turnover ratio. Creditors turnover ratio. Formula for creditors turnover ratio is credit purchases by average accounts payable. Now credit purchases, we'll have to calculate it. For doing that calculation, they've given sales 13 lakh. GP is 25%, which means COGS is 75% into 13 lakh. 75% into 13 lakh, which is going to be 13 lakh into 0.75, 9,75,000, and COGS is equal to opening stock plus purchase minus closing stock plus if any direct expenses are there, any direct, this is what you would have learned in trading account. COGS is equal to opening stock plus purchase minus closing stock, 975. It's a very good question, no major tricky adjustment. 250 plus purchase 375. Exact same question is not there in my material, but this adjustment we've discussed at many places. Exact same MCQ is not there. 250 minus 375, this goes the other side, you will get the purchases figure. Purchases figure is plus 375 minus 250, you get 11 lakh, and 11 lakh purchases figure is 11 lakh. 11 lakh divided by 80,000. I think kind of a straightforward adjustment. Divide by 80,000. 13.75 times is the creditors turnover ratio. 13.75 times is the creditors turnover ratio. We're not discussing the logic of the formula. All that I cannot discuss now. I'll just be discussing the questions and their answers with the calculation part of it. So second question is done. Third question is same. It is there in our material. It is there in concept 8 of the leverages chapter. So if you have done classes with me and if you have already seen the concept book, then beyond this, that is question number 3, you need not refer, but it's an MCQ. You can go through the video if you want, or you can move. I'll be putting timestamp for every question. So if you want, you can move to question 4 timestamp. Question 3, same as concept 8 of leverages chapter. A firm has sales of 75 lakh, variable cost of 42 lakh, fixed cost of 6 lakh, debt of 45 lakh at 9%, equity of 55 lakh. Does it have favorable financial leverage? Does it have favorable financial leverage? ROI is less than interest on loan. ROI is less than interest on loan. If it is lesser than interest on loan, we technically call not a favorable financial leverage. We don't know. We'll have to calculate ROI. ROI is equal. Equal means we cannot say it is favorable, unfavorable. It is technically indifferent. Greater than interest on loan, hence it is favorable. Greater and it is unfavorable. First of all, this option is eliminated, because if it's greater than interest on loan, then it is a favorable financial. ROI greater than interest on loan is called favorable financial leverage. Lesser than interest on loan is called unfavorable. First, let's calculate ROI. ROI is equal to, tax is not there, EBT divided by equity. EBT is 75 lakh minus, sorry, ROI is EBIT by ROE, that is ROE, EBIT by debt plus equity, sorry, EBIT by debt plus equity. ROI is EBIT by debt plus equity. ROE is EBT by equity, EBT divided by equity. 75 lakh minus 42 lakhs minus 6 lakh divided by debt plus equity. 45 plus 55. So 75 minus 42, 33, 27 lakh, 100 lakh. We get 27%, which is obviously greater than the 9%. So it has favorable financial leverage. 27%. ROI is greater than interest on loan, and hence it has favorable financial leverage. This question is same as concept 8 of leverages chapter. Okay, I proceed to question 4, which is also exactly same. I think when I say exact same, numbers can be different in our material versus this material. No new adjustment. So if you are my student and you have already seen question 42 of ratio analysis chapter, you need not refer this segment of the video. For others, obviously I'll discuss it in detail. Following are the data in respect of ABC Industries Limited for the year ended 31st March 2021. Debt to total asset ratio 0.40. Debt to total asset ratio 0.40. Every item we read, we'll have to make sense out of it. Debt to total asset ratio is this 50 lakh. This will also be 50 lakh, and debt to total asset is 0.4, which means debt by total asset is 0.4. Debt by 50 lakh is 0.4. Debt is 20 lakh rupees. Every question you can please pause before I explain it. See full question at your hand. Be fully satisfied by reading the question and then you keep referring it. Debt is 20 lakh rupees. Then long-term debt to equity ratio is 30%. Long-term debt. Now this debt to total asset can be understood as long-term debt alone or can be understood as total outside liability. Total outside liability. There are two ways of interpreting this. I'll do that interpretation as we proceed. Later on, I'll do what interpretation I want to take out of this debt. Debt to total asset is 0.40, can be long-term debt plus accounts payable, can only be long-term debt. Long-term debt to equity, we'll use it in some time. GP on sales is 20%, which COGS is given. So COGS equal to 80% of sales equal to 64 lakh. Sales is 80 lakh rupee. Sales is 80 lakh rupee. Accounts receivable is 36 days. Assume 360 days in a year. So 80 lakh into 36 by 360 is 8 lakh rupee. Into 36 by 360. 36 by 360. 8 lakh rupee. That's the number of your accounts receivable. Accounts receivable has to be that number. Inventory holding is 60 days. So inventory is equal to 64 lakh into 60 by 360. Inventory holding is 64 lakh into 60 days. 60 days. 60 by 360. 10 lakh 66,667. Now comes an important assumption. As I said, I'll need one assumption to be taken. What is that debt to asset ratio? That 0.420 lakh, is it together? Looks like it will be together. Why will it be together is, listen. Long-term debt is 30% of equity. Long-term debt is 30% of equity. If you take that 20 lakh to be 30% of equity, if you take 20 lakh rupees, which is what we calculated, equity number will be some 66 lakh, which is not possible. The equity number will be 66 lakh, which is not possible. So this together, this is how you have to make assumption. Can't help it, because the debt to asset ratio can be understood as total debt, total outside liability, long-term debt. There are multiple formulae for this. You can take any of the formulae you wish to. So if you take total outside liability, if you take total outside liability, this together is 20 lakh. This will be 10 lakh. 20 plus 10 is 30. Long-term debt is 30% of this 30 lakh. 30% of this 30 lakh, which is 9 lakh. Accounts payable balance is 11 lakh. Accounts payable is 11 lakh. There's a need for an assumption to be taken. Good question. It's a good question to revise. Now, I've almost used all the ratio. One ratio which I'm yet to use is quick ratio. So quick ratio is equal to quick assets by current liability. 0.9 is equal to quick assets by 11 lakh. Quick assets is equal to 9 lakh 90. In the quick asset, I have accounts receivable. So this is 1 lakh 90 and fixed assets is balancing figure. Fixed assets is balancing figure. This is what I said, debt to, it is assumed that debt includes accounts payable. Debt includes accounts payable. We have considered total outside liability for calculation. We have considered, if you take only that, you will get 20 lakh as long-term debt. That can't be 30% of equity. Equity value will become some 66 lakh. The balance sheet total will not work. The balance sheet total is not going to work. So certain assumptions are needed. We can't help it. With this question gets over. As I've been telling you, please pause video at multiple places and be clear on the various computation, and then you do it on your own. I'll be moving to the next question. So as I said, you first please read the question. You'll have to number your working notes like I have numbered it, because when you number it easily, it is easy for the examiner to verify your answer. I'll be moving to question 5. At this stage, please pause the video, go through the full question, and then I'll take you through the explanation part. Okay, now I'll move to the next question. Question 5, it says similar. Similar means some changes will be there from that question which is there in our material, but it's very similar. BS Limited has the following book value capital structure as on March 31, 2003. Particulars: amount, equity share capital, 11.5% preference share, 10% debenture. Equity sells for 300. Will pay a dividend of 15 per share, expected to grow at 5%, assume a 35% corporate tax rate, calculate WACC based on the existing capital structure. Fairly simple, straightforward question. 3 forms of capital is there. Cost of equity, our formula is D1 by P0 plus growth rate. D1 by P0 plus growth rate. D1 is 15 rupees. P0 300, growth is 0.05, put together 0.10 or 10%. No extra data on preference, so cost of preference is 11.5 as it is. No extra data on debenture, so cost of debenture is 10 into 1 minus tax rate 0.35, 6.5%, and then we put this data as source, cost, weight, product, equity, preference, debt. Equity is 10%, preference is 11.5, debenture is 6.5, weight is whatever the value. Equity weight is 300, preference 60, 100. Sum of product by sum of weights. I don't add up the weights to 1. I'll just do sum of product by sum of weights, which is basically this calculation. 10%, 11.5, 6.5. Product, sum of product by sum of weights, 9.43%. Straightforward, simple calculation. I don't have anything much to explain in the first part. Second part, they've added one extra good adjustment. That's a very good adjustment which they have added. They have said, I'm going to raise an additional capital of 50 lakh. Whenever you raise any additional capital, the cost of the existing components of capital, that is cost of equity or the existing preference share, existing debenture, may or may not change. And to raise 50 lakh debt by issuing 10 year means it's a redeemable 12% debenture, yield on similar maturity and risk classes 13%. Very good information. By issuing 10 years, 12% debenture, it is a 12% debenture, but the yield on similar maturity and risk class, similar maturity and risk class is 13%, means others in the market are expecting 13%. We are giving only 12%. We are not meeting expectation. Bond will be issued at a discount. Whenever you are not able to meet the expectation of the investor, bond will have to be issued at a discount. Flotation cost, face value of debenture. Also, equity dividend will increase to 20. Growth rate unchanged. Price will fall down to 250. So, this will impact my KE calculation. This is going to impact my KE calculation. So, let's first see. Now, I have 4 forms of capital: KE, KP, cost of existing debt, and cost of a new debt. KE will now changes 20, 250, 5% growth, 0.08 plus 0.05, 13%. So cost of equity now will be 13%. Earlier the cost of equity was lesser. Now it increases to 13%. Preference remains same. Preference remain same as 10 and 11.5%. Existing debenture remain 6.5%. New debenture, it says 10 year. 10 year means it's a redeemable debt. It's a redeemable debt. Cost of redeemable debt is equal to interest after tax, average other cost divided by average funds employed. I'm going to pay 12% on a face value of 100 rupees, which is 12 into 1 minus tax. So 12 into 0.65, 1 minus tax. 12 into 1 minus tax rate, 12 into 0.65. Redeemable value, nothing is given, so it will be 100. Net proceeds is issue price. See, if the data on yield and all was not given, we would have assumed that issue will happen at par value. Our assumption normally is issue will happen at par value. But in this question, they have given data point. They have given data point which talks about yield on similar maturity in risk class. It's very simple. Logic is simple. If you pay 12% or 12 rupees, sorry, if you pay 13%, people are expecting 13%, then people will pay par value. 13%, 13 rupees, people will pay par value. You are paying only 12%, 12 rupees. So the price will change. What will be the price now? Cross multiplication, 12 by 13 into 100. We are paying lesser. Because we pay lesser, we will get a lesser issue price. So 12 by 13 into 100, 92.31. From this 92.31, flotation cost is 2%. Problem is silent. I assume flotation cost to be on face value. I assume the flotation cost to be on face value. It says flotation cost 2%. You can take it on face value. You can take it on issue price. I assume it to be on face value. So my net proceeds is 92.31 minus 2 rupees, 90.31. I bring this 90.31 here. It is 10 years. Whole divided by average funds is redeemable value plus net proceeds by 2. Redeemable value plus net proceeds by 2. So the calculation is 12 into 0.65, 7.8. 100 minus 90.31 divided by 10, 0.969, and 191.3 divided by 2. So numerator is this plus this, denominator is this. 12 into 0.65, which is the tax rate given in the question is 35%. 12 into 0.65. My issue price is 92.31. 92.31. I deduct 2 rupees in that. 90.31. 100 minus 90.31 divided by 10 years. 100 minus 90.31 divided by 10 years. Sorry, this is 191. Denominator is this 95.155. 100 plus 90.31 divided by 2. 9.22215. So let's make it 9.22%. Most important calculation, I'll explain again. It says I am going to issue 10 years 12% debenture, but the yield on similar maturity and risk class is 13%. So normally you should give me 12%, but here you will have to give me 13%. So normally people are giving 13%, but you are issuing only at 12%. You are not meeting the expectation. You'll have to issue it at discount. 13%, 100 rupees will be paid. 12% proportionately lesser will be paid. There is a formula called, this is technically a formula called current yield is equal to interest by current market price. You learn this at CA final. Hence current market price is equal to interest divided by current yield, 12 divided by 13%. 12 divided by 13%. Once we got this, I'll put it in the same table format. Equity, preference, debt, new debt, sum of product by sum of weights. I'm not spending much time on that. Sum of product by sum of weights. Take the cost, multiply with the weight. I don't ensure that weights add up to 1. Final answer will match. Final answer is going to match. This is on cost of capital. I'll be moving to the next question. As I said earlier, you can please pause the video, go through the full question. Next question, go through the question, which is your question 6, and then I start solving it. Company XYZ is unlevered, has a cost of equity of 20%, market value of 10 crores. Company ABC is identical to XYZ in all respect except that it uses debt finance. It uses debt finance in its capital structure with a market value of 4 crore and a cost of 10%. Find the market value of equity, WACC, cost of equity if the tax advantage of debt is 25%. This is similar to question 31. Now onwards, all questions which are there, it is similar to some or the other question which is there in our material. This is similar to question number 31, capital structure chapter, which is my addition to. All linkages is to addition to which I have released. Now this is Modigliani-Miller problem. Why Modigliani-Miller? Because they're talking about tax advantage of debt. Tax advantage of debt was discussed in Modigliani-Miller approach. This is with the tax. We had a format. We'll first put the format, and format will quickly give you the answer. So let's put the format. Our format starts with EBIT less interest, EBT less tax, EAT, leave a line, KD, KU, KE, KO, value of debt, value of equity, value of firm. In case you have doubt on this format and all, go through my concept book. There everything is explained in depth. So that can give you, this format can help you in answering most of the questions on Modigliani-Miller or any other theory. So I would suggest you to go through that because that will be very useful for you. So EBIT less interest, EBT less tax, EAT, KD, KE, KO, value of debt, value of equity, and value of firm. Now the data I have is, I have two companies, XYZ unlevered. XYZ is unlevered, so which I'll have to write separately. And then ABC is levered. XYZ unlevered and ABC is levered. First we will complete the calculation of unlevered. Though the requirement of the question is to find out market value of equity, weighted average cost of capital, and cost of equity of ABC. First let me close XYZ. So XYZ has a cost of equity of 20%, cost of equity of 20%, debt not applicable. KO will also be 20%. Why KO is 20%? Because it's very simple. There is no debt in this company. Then it's it. Zero debt. 10 crore is the value of firm as well as the value of equity. Both will be same. Both will be same. We technically have three main formulae, and these three formulae will give us most of the answer. The first formula I had is cost of debt is equal to interest into 1 minus tax by value of debt. KE EBT into 1 minus tax by equity, and KO EBIT into 1 minus tax by firm. I'll use the formula of KO and get the EBIT. I'll use the formula of KO and get the EBIT. So KO 20% is equal to EBIT into 1 minus 0.25 divided by 10 crores. 10 crores goes to the other side, you get 2 crore. Divide by 0.75 is equal to EBIT. 2 crore divided by 0.75 is equal to EBIT. So three main formula: cost of debt is interest into 1 minus tax by debt, K is EBT into 1 minus tax by equity. Cost of debt is on interest, cost of equity is on EBT, or technically EAT it will become, and KO is on EBIT. KO is on EBIT. So 2 crore divided by 0.75. Interest is not there. EBT will be same number. Tax is 25%. And EAT is 2 crore. EAT is 2 crore and 10 crore is the value of firm, and EAT is 2 crore rupees. Now ABC is almost similar. The only thing is it has debt in its capital structure. It has a debt of 4 crore. Now this is a formula of Modigliani Miller. Value of levered firm is equal to value of unlevered plus tax rate is 25%. When they say tax advantage of debt is 25%, it means tax rate is 25%. So levered is equal to, levered is technically ABC, 10 crore, 4 crore into 25%. 11 crore is the value of ABC. If you look at ICA solution, they have done some huge formula and all. Nothing needs to be done. Very simple calculation. 10 crore plus 4 crore into 25%, 11 crore is the value. So I write 11 crore here. Value of debt is 4 crore. Equity is 11 minus 4, 7 crore. Equity is 11 minus 4, 7 crore. This answers, if you look at the requirements, requirement was find out the market value of equity, done, 7 crore. And then they have asked for WACC and cost of equity. WACC and cost of equity, it will come in our format itself. So identical means same EBIT. Interest is 4 crore into 10%. 10% is the rate of interest. Cost of 10% is technically rate of interest is 10%. EBT. Tax is same 25%. I get EAT. Cost of debt is interest. It's not needed, but still 40 lakh divided by 4 crore. 40 lakh into 1 minus tax rate. Interest into 1 minus tax rate. So 40 lakh into 0.75 divided by 4 crore. It will be 7.5%. It is going to be 7.5%. 40 lakh into 75%. 30 lakh divided by 4 crore. Cost of equity is EBIT, sorry, EBT into 1 minus tax rate. EBT into 1 minus tax rate divided by value of equity. Divided by value of equity. Just a minute. EBT into 1 minus tax rate divided by value of equity. I'll keep it as 2 decimal answer. 24.29. And KO is EBIT into 1 minus tax rate by value of firm. By value of firm. 18.18. So these are the two requirements. 18.18, 24.29. As I said, the format will guide you to the answer. The format will give you everything. Be very clear on the concept and the format. It can help you in answering any kind of capital structure question. That is on the theory side. On the theory side, any kind of a theory question can be handled with this. You'll see I have put it in this format. ICA solution is, they have done some formula approach and all. You can see in the RTP, but this itself will give you the answer. Question 7, same means no change. So my students, if you want, you can avoid this video. That is the segment of the question, or you can see it. Following data relate to two companies belonging to same risk class. Same risk class means similar risk is there. Depending on the theory, our conclusion will change. Net operating income, the term net operating income or operating income means EBIT, Then they have given equity capitalization rate. Determine the total market value, equity capitalization rate, and WACC, no tax. If income tax is not there, both company will have same value as per approach. Both company will have same value as per approach. And if income tax is there, the unlevered one will have levered plus amount of debt into tax rate. I'm going to use the same format. And it is going to guide me to the solution. So let's write it, the particulars, let's call it as two companies, levered company, unlevered or unlevered levered, whatever way they have given, levered, unlevered, whichever order you do. Particulars, levered, unlevered. I will not have this, that is tax will not be there in this question now. Tax data will not be there initially, and then I'll bring the tax part. So in my formula, cost of debt is interest by debt, cost of equity, EBT by equity, cost of capital, EBIT by firm. That's all. No into 1 minus tax, no into 1 minus tax. That is without income tax, without income tax. Let me write the values given. EBIT 18 lakhs, 54 lakh is the amount of debt, 12% is the cost of debt. So interest is 54 lakh into 12%. Here no interest charge because it's unlevered, not applicable. Cost of equity of the second company alone is given 18. Cost of capital will be 18. Cost of capital will be 18. This is the data. This is more than sufficient for me to solve the question. Value of debt is 0. As I said, KE now is EBT by equity, and equity is equal to EBT by cost of equity. EBT by cost of equity. 18 lakh divided by 18%. 18 lakh divided by 18%. 1 crore. Put together 1 crore. As per approach, both the companies will have what? Same value of firm. Both the companies are going to have same value of firm if income tax is not there. So copy paste 1 crore. Equity balancing figure 46 lakh. KE, EBT by amount of equity. EBT by amount of equity. KO, EBIT by value of firm. That's all. It's a very simple approach. This is without tax. Without tax is fairly simple. Without tax is more easier than with the tax scenario. But the only thing is, without tax means both company will have same value. There will not be any difference in the value of two companies. Will not find even a 1 rupee difference. Both the companies are going to have same value of firm. Then I'll repeat this with income tax. So with income tax means you'll have to do less tax, EAT, and changes will obviously be there. Interest is whatever it is, 6,48. Let me not adjust that. And now certain changes will come and we'll have to complete the calculation. So EBIT less interest, EBT, less tax, EAT, KD, KE, KO, value of debt, value of equity, and value of firm. We are going to bring all these items and then complete the calculation. Now this is a very simple approach. My tax part given in the question is 40%. EAT. Let me close the unlevered part. Not applicable. 18. Value of debt is 0. Value of debt is 0. 18% is the number. We have 18% number. Now I'll come to value of equity. Now what is value of equity is KE is equal to EBT 1 minus tax value of equity. So what I am going to do here is 18 is equal to 18 lakh into 1 minus 0.4 by equity 18%. Equity is equal to 10 lakh 80 divide by 18%. You will get 60 lakh rupees. Equity value is 60 lakh. Value of equity is 60 lakh rupees. You're going to get value of equity as 60 lakh rupees. Value of equity 60 lakh. Value of firm is also 60 lakh. This is unlevered. This is the unlevered calculation. Levered is unlevered firm. Value of levered is equal to what? We repeated this many times in my regular class. Value of unlevered firm plus debt into tax rate. Debt into tax rate. Unlevered firm is 60 lakh. Unlevered is the one which does not have borrowing. Debt figure given in the question is, for the unlevered form, the debt figure is 54 lakh into 0.4. All put together, it will add up to 8160. Earlier, both companies had same value. Now difference 8160. This is 54 lakhs. Equity balancing figure 2760. Equities, debt plus equities firm. Debt plus equities firm. Equity balancing figure is 2760. Equity balancing figure is 2760. Cost of debt is interest into 1 minus tax rate divided by value of debt. Interest into 1 minus tax rate is 0.6 or 0.6. K is EBT into 1 minus tax rate by value of equity. KO EBIT into 1 minus tax rate by value of firm. Very simple. Everything is fairly simple, straightforward calculation. It's fairly simple. Be very clear on the format. You will be in a position to handle any type of question on capital structure. Many people get confused in this chapter because they are not aware of this format or how to follow with the standardized format. Clear? This is what you will see in the solution also. We would have followed a format. This is for the first situation. Then in the second situation, again, we have repeated and we have got this answer. I'll be moving to question 8. Before I do question 8, again, you can pause for a minute or two, go through the full question and then refer to my explanation which I'm giving. So you can pause for a minute and then we start 8. Okay, let's move to question 8. Following date of PC Limited under situation 1, 2 and 3 and financial plan A and B is given. Installed capacity, actual production and sales, selling price, variable cost, fixed cost. Situation 1 can be 3000, situation 2 can be 6000, situation 3 can be 9000. The fixed cost figure is going to undergo a change. In situation 1 it will be 3000 rupees, situation 2 6000, situation 3 9000, and I can borrow 15,000 rupees or 7,500 rupees. The plan, the financial plan will also change. This is not exactly same question. Similar question is there. Question number 13 of leverages chapter. Now the fixed cost can be 3 things. So here I'll have to do combination approach. What is combination approach? Fixed cost, leverages occur because of fixed cost. They want us to calculate OL and FL and combination of OL and FL. What is combination of OL and FL? Combined leverage. Combined leverage, which gives us the highest value and which gives us the lowest value. I can answer highest and lowest even without doing. Highest value will come highest fixed cost, highest interest cost. Lowest value will come lowest fixed cost, lowest interest cost. Lowest fixed cost and lowest interest cost. They have asked us to do OL and FL. So 3 situations for fixed cost and 2 situations for borrowing. 3 into 2, 6 possible situations. So it will be like this: particulars, fixed cost 3000 plus A, 3000 plus plan B, 6000 plus A, 6000 plus B. That is fixed cost can be 3000 and plan A, plan B. 6000 plan A, plan B. 9000 plus A, 9000 plus B. I will do it in our leverages format. What is leverage? Sales less variable cost, contribution less fixed cost, EBIT less interest, EBT. Depend, if you have tax and other things, then you write it beyond EBT. Otherwise, stop at EBT. Now coming to sales number, 3600 I think is the capacity, no use to us. 2400 is the actual volume. So 2400 into 30, sales is 72,000. Same for all the 5. So I'm not writing that. Variable cost is into 20, 48,000. Contribution is 24 for all the 3. Fixed cost will change. 3, 3, 6, 6, 9, 9. Contribution divided by EBIT. Contribution, it's a very straightforward question. Contribution divided by EBIT will give me something called as your operating leverage. So this is 21,000, 21, 18, 24,000 minus 6, 15, 15. Interest cost in the first option. What is the first option? Plan A, 15,000 into 12%, 1800, and plan B is 900. So plan A, 1800, 900. I get EBT 19,200, 20,100, 16,200, 17,100, 13,200, 14,100. Beyond this, I'm not doing it. Operating leverage is contribution divided by EBIT. Contribution divided by EBIT. Financial leverage, EBIT divided by EBT minus preference dividend. All that is not there. And combined leverage is contribution divided by EBT minus the preference dividend. As I said, highest is for high fixed cost and high fixed cost and high interest cost, 1.82. High fixed cost and high interest cost. Lowest is low fixed cost and low interest cost. Above calculation, highest value in situation 3 financed by plan A. Situation 3 financed by plan A. Situation 3 is 9,000 fixed cost and high borrowing. And lowest value situation 1, lowest fixed cost financed by plan B. Plan B has lower interest. Plan B has lower interest. This is 3 into 2, 6 situation. It can also become 3 into 3, 9 situation also. It can become 3 into 3, 9 situation as well. Next, I'll be moving to 9. Pause and then see my explanation. Okay. Following information, this is the same as question number 13. Same means we already have this problem. Following is the information for QB Limited. Net profit 30 lakh, 12% preference share capital 1 crore, equity capital 60 lakh, retention ratio 75%, cost of capital 18%, internal rate of return on investment 22%. Gordon's formula, Walter's formula. Let me first close Walter because with the data of Walter I can do Gordon then. So what did Walter say? Walter said D by KE R by KE into E minus D. This is also divided by KE. Now 30 lakh is my net profit. In that preference dividend is 12 lakh rupees. Preference dividend is 12 lakh rupees. So 18 lakh divided by 60 lakh share, 6 lakh share. 3 rupees is the earnings. Retention 75, payout 25. So 0.75. 3 rupees is the earnings, 25% payout, 25% payout, 0.75 divided by 18%, 0.22 divided by 0.18 into 3 minus 0.75 whole divided by 0.18. I don't want to really get into the calculation, but I'm doing it. 0.75 divided by 0.18 is 4.17, 0.22 into 2.25 divided by 0.18, further divide by 0.18. Some 19.44 or 45. That's the answer under Gordon's formula. Sorry, Walter's formula. Walter's formula. Gordon said P naught. At any stage you are not able to understand something, play it at lesser speed or rewatch it or watch it again. P naught is equal to, because this is RTP discussion, logic is you would have gone through all the concepts earlier and then coming to this stage. P naught is equal to D1. See, I can give two answers because ICI is not very consistent. That 0.75 can be taken as D0, can also be taken as D1, can be taken as D0 or D1. If I take it as D0, 0.75, K is 0.18, growth is IRR into retention ratio. IRR into retention ratio. 22% into 75%, you will get 16.5. 0.75 plus 16.5%, you will have to add it in the numerator. If you don't add it in the numerator, then 0.75 is directly D1. 0.75 is directly D1. We always have this confusion. ICA is not consistent. So first answer is 0.75 into 1.165. What is 1.165? Adding the growth divided by 0.015 divided by 1.18 minus 0.165. I get answer is 58.25. Second answer is not adding the growth on this. Not adding the growth. In that case, you'll get 50. I'll always give two answers for Gordon because consistency. It all depends on when will this dividend be paid. If it's going to be paid immediately, it's called D0. If it's going to be paid after a long period, then it's called D1. So two solutions. So we got 19.45 under your Gordon's formula, sorry, Walter's formula. Gordon to answer 50 and 58.25. 50 rupees and 58.25. Twin answers are there. Clear? I'll move to question 10. Pause and then go through my explanation. Question 10. MN Limited is commencing a new project for manufacturing of electric toys. Following cost information has been ascertained for annual production of 60,000 units at full capacity. Raw material, direct labor, manufacturing overheads, variable, fixed, selling and distribution overhead, variable, fixed, total cost, profit, selling price. In the first year, production and sales will be 40,000 and 35,000. Assess the need of working capital following data: stock of raw material, debtors, creditors, wages, overheads, cash in bank. Provision for contingencies required at 10% of working capital, including that provision. You are required to prepare a statement of working capital requirement. Debtors are taken at cost. Because the question said debtors are taken at cost, I have assumed, or IC has assumed, will follow total approach. There are two approaches. One is called total approach and second is called as your cash cost approach. We are following total approach for estimation, but debtors alone will be at cost of sales. But we are going to follow total approach. First thing we have to do is a cost sheet. We'll have to prepare a cost sheet. This is what I used to tell my students, that you'll have to prepare a cost sheet. Same as question number 20. Every question on working capital management, wherever you do estimation, please prepare a cost sheet first. Without cost sheet, you will not be able to get to the answer. Just give me a minute. Okay, so let's prepare a cost sheet. Particulars, calculation, amount. Once the cost sheet is done, everything else will automatically fall in place. It's a new company. If it's a new company, then you'll have to write opening stock, closing stock. Existing company means we don't write opening stock and closing stock. So raw material, opening raw material, add purchases less closing raw material, we get raw material consumed. Opening raw material, add purchases less closing raw material, and we get raw material consumed. Now opening raw material for a new company will be 0. It is a now commencing a new project. New project is like a new company. Opening, because there will not be any opening raw material or opening WIP or opening FG. Raw material consumed is, we have produced 40,000 units. So 40,000 into 20. 40,000 into 20. See, if it's an existing company, we don't write separately because RM purchased and RM consumed is assumed to be same. What will be closing raw material? That's given in the question. Stock of raw material 3 months. 8 lakh into 3 by 12. 3 months consumption. 8 lakh into 3 by 12. 2 lakh. This is balancing figure. Purchases is balancing figure. It is 0 plus 10 minus 2 is equal to 8 lakh. 0 plus 10 minus 2. We are preparing a cost sheet, but not a detailed cost sheet. I'll do only few items. 0 plus 10 minus 2, 8 lakh. This is raw material consumed. Then I have direct labor. 40,000 into 15. This question does not have any WIP adjustment, else we have to make WIP adjustment also here. Direct labor 40,000 into 15, 6 lakh. Variable, I don't write prime cost and all. Variable manufacturing overhead 40,000 into 15 again, 6 lakh. Fixed manufacturing overhead. Fixed manufacturing overhead is 10 rupees, but be very clear. This 10 rupees is on 60,000 units on the overall capacity. At full capacity, this is the cost information. Variable cost changes with units. Fixed cost do not change with units. So this 10 will be multiplied with 60,000 units. Total is called as GWC, gross works cost, net works cost, because there's no opening or closing WIP given in the question. Then COP, GWC, NWC or COP. This is for 40,000 units. This is for 40,000 units. Gross works cost, net works cost or COP. 40,000 units is 26 lakh rupees. For 40,000 units, the value is 26 lakh rupees. Add opening FG 0 less. Once the cost sheet is done, no, then it is very simple. Cost of goods sold. Now closing FG is, question has given some data. What is the data? 40,000 is my production. Sales is 35,000. 40,000 is my production. Sales is 35,000, which means 5,000. 5,000 is going to be what? 5,000 is going to be technically that 5,000 is your closing stock. So cost of production divided by 40,000 units into 5,000 units. Cost of production divided by the closing FG units into 5,000. I get COGS. After COGS, we have variable selling overhead, fixed selling overhead, cost of sales, profit, and sales. Variable selling overhead is 3 per unit. Any variable cost selling overhead will be on units sold. So 3 into 35,000. And this will be 1 into 60,000 overall capacity. COS, sales is 35,000 into 80. Profit is balancing figure. And thereafter estimation is very simple. Estimation is not my worry. Cost sheet if done, estimation is going to be very simple. Always the trickier part is cost sheet. Doing the cost sheet correctly is very important. Every problem I prepare a cost sheet first and then only I do estimation. Let's get into estimation now. Stock of raw material already done. Credit allowed by debtors. This as per cost into 1.5 by 12 into 1.5, 1.5 months divided by 12. Credit allowed by debtor, creditors 4 months, purchases into 4 by 12. Purchases into 4 by 12. Lag in payment of wages, wages into 1 by 12. Wages into 1 by 12. Very simple. Lag in payment of overhead, half. So you will have to add variable manufacturing overhead, fixed manufacturing overhead, variable selling overhead, fixed selling overhead, everything add and half a month into 0.5 by 12 into 0.5 by 12. Cash is given 60,000. Provision for contingency alone I'll have to explain because it's 10% including that provision. So if I come to this part, I copy from there. Debtors, as I said, 3,05,000. Cash is there. Creditors, all this we estimated. We get working capital 449,792. Listen, working capital, add contingency and final working capital. Now question has said I want a contingency of 10% on the final working capital including the contingency. On the final working capital including the contingency. This is very, very important adjustment. It is on the final working capital including the contingency. So take this as 100, contingency is 10, and this is 90. 90 equal to 449. So 449,792 into 10 by 90. This is like profit margin, which can be on cost. Profit margin can also be on sales. Can be on cost, can also be on sales. So 449,792 into 10 by 90. 49,977. I get my final working capital. Moment, very, very clear. Moment you are done with something called as cost sheet, balance is just a formality. Balance is just a formality. I'll be moving to question 11. Pause and then come to my explanation. Let's come to 11. Banu Limited is considering relaxing. This is on working capital management, receivables management. I have a standard format even for this. So look at 11, I have a standard format. Question 10, we had a standard format. Leverages, we had a standard format. 2 questions on capital structure, we have a standard format. So many questions are format driven. WACC, we have a standard format. So lot of questions can be done if you are aware of the standard format. Banu Limited is considering relaxing its present credit policy. Process of evaluating 2 proposed policy. Annual credit sales of 225 lakh. Turnover ratio, receivable turnover ratio is 5 times a year. Bad debt is 7 lakh 50. Firm wants to give a return of 20% on the investment in new accounts receivable. Option 2 requires a manager to manage the receivable. Managing the receivable is called credit administration cost. Managing the receivable, variable cost is 60%. Given the data, which is a better option? Credit sales. So we'll put this in our standard format. What is standard format? Sales less variable cost less fixed cost, gross benefit. 4 cost, less bad debt, less credit administration, less interest cost, less cash discount, and I get net benefit. Whichever gives me highest net benefit, I can choose that. Whichever gives me highest net benefit, I go ahead and choose that. Very simple analysis we are going to do. Very simple format we have. I'm going to put it in that format now. Particulars, present, option 1, option 2. We'll start with sales 225, 275, 350 less variable cost. Variable cost is 60% of selling price. Variable cost is 60% of selling price. Fixed cost is not given. Gross benefit are technically called contribute. Technically called the operating profit. This is technically the operating profit. Gross benefit. In this question, it is contribution because there is no fixed cost. Less bad debt, less interest cost, less credit admin cost, less cash discount, which is not there. I'm just giving you the normal format because if you are not my student, you will appreciate these formats. Net benefit. Always ensure to follow standard formats to solve questions so that you'll be able to handle any type of question. Bad debt is given in the question. Bad debt is 7.5, 22.5, 47.5. Interest cost I'll calculate in a minute. Credit admin is for option 2. You will have to employ somebody. In option 2, policy option 2 requires a manager to manage the receivable with a salary of 50,000 per month. 50,000 per month into 12 months is 6. Cash discount is not there. I'll get to net benefit, but in that first I'll have to calculate note 1, computation of interest cost. Now what is interest cost? Is debtors into the required return. Some required return would be given. 20% on the investment in receivables. 20% on the investment in receivables. So that is interest cost is what? Some money stuck in debtor. If money is stuck on debtor, I technically will have some loan against it, because anything on the asset side needs something on the liability side, and on that I'll have to pay interest. So my debtors is, first I'll do full cost of sales. What is full cost of sales? Is variable cost plus fixed cost. Normally debtors is valued based on full cost of sales. We have full cost of sales, VC of sales, and the sales approach. So if problem is silent, we go with full cost of sales. So variable plus fixed is not there. 135, 165, 210. Debtors is equal to, what is debtors turnover ratio? Debtors turnover ratio is equal to credit sales by receivable. Hence receivable is equal to credit sale by debtors turnover ratio. It's not credit sales, it's full cost of sales. It is full cost of sales divided by the debtors turnover ratio, which is 5, 4 and 3. And on this I'll calculate interest cost. Interest cost is 20%. I don't have much to explain. Interest cost is 20% of the debtors. Interest cost is 20% of the debtors. Subtract the interest cost, whichever gives you highest net benefit. Go ahead and choose that. Whichever gives you highest net benefit. So put the interest cost here and get the net benefit. $77.1. I'll obviously choose option 2, because I get the highest net benefit after incorporating increase in debtor, everything. 79.25 is better. So I'll go ahead with option 1, policy option 1. 12A and 12B are theory questions. These are also there in my material. Question 9 of chapter 1 of theory book is question 12A, and question 5 of chapter 2 of theory book is question 12B. So it is covered in the theory book. So we have covered the entire RTP. I have covered it from an understanding that you are aware of the subject and you are using this for the revision purpose. In case you have any doubts in this, you can send me a message in WhatsApp, or you can type it here. I'll clarify your doubts. So whichever way you want to do, you can do that. Thank you, friends.